Hey there, YouTube. So you're thinking about building a fund, but you're not sure how to allocate your resources to individual stocks within your portfolio. You've got a diversified portfolio, you've picked your favorite stocks, and you want to go through a scientific mathematical way to figure out how to allocate percentage of your resources to each of those stocks. I'm going to show you modern portfolio theory and the efficient frontier, which establishes a framework to allocate resources to your portfolio and get the most amount of return for the least amount of risk. This is an educational video, so grab a pencil, grab a piece of paper, grab some coffee, and I'm going to show you mathematically. We're going to nerd out a little bit. I'm going to show you how to set all this up from start to finish. And if you like this video, please subscribe. And with that, let's jump in. All right, so the first thing that I'm going to do is I'm going to use a platform like TradingView. I think you can do this in Yahoo Finance as well. But you need to download a bunch of stocks, and you need to download the historical data. So I've loaded up my stocks that I like, and I picked some random ones as well that just to kind of illustrate how this thing works. And I've got 18. Typically speaking, you want at least 20 to 30 in a well-diversified portfolio. We're also going to use this portfolio to create a fund, and I'm going to demonstrate some of the things I've been talking about with puts and calls, how to enhance the portfolio. We'll figure out what the beta is of this portfolio. That'll be in a separate video, and then we're going to build a fund using these individual stocks. So I've got several here listed. I've already set this up to monthly because I want to grab the average monthly returns, and then I'm going to compare it to the 10-year rate. We're going to build a border covariance matrix, and then we'll build out the efficient frontier. So I've got this. I'm going to download this. So once I have it all loaded up, you're going to export the chart data, and I'm going to pick the ISO time. I'll export this. All right, it's done. So let me open that. Okay, now that we have this file open, this is what it looks like initially. So I know that the first stock was DHI, and I'm always going to use closing price. I'm just going to change this to DHI. I'm going to get rid of these. I really don't care about the open, high, low, close. I'm looking for monthly returns. And then I'm going to go through and do some formatting, and I'm going to change this one to DHI, get rid of, some of these extra characters, change that to Home Depot, Netflix, Starbucks, PayPal, and so on. I'm going to do that for all of these. And then I'm going to go through and I'm going to clean these up, and I'm going to change these to either zeros or blanks because the stock didn't exist back in 2014. This is CMG, Chipotle, and back in 2000, it did not exist. So I'm going to get rid of some of these. I'm also going to go up to 2014, and I'm going to delete all of the data back before 2014. So I'm just going to grab the last 10, 11 years, and then we'll start working with that, and we'll massage that. So I've done that already, and let me jump into that. Okay, now that I've done that, just to save time on the video, I'm going to show you the spreadsheet that I created. And I went and I grabbed from January of 2014 and grabbed everything forward. All right, so DHI, for example, here's the stock was run at $23, and then 24 the next month, 21, 22. What I'm going to use next is I have to get the average monthly returns. So I've built a column right next to it with the average monthly returns. So, or with the monthly return. So I'm using log normal distribution, and I'm basically just grabbing the difference in the percent return. So this is 4.4. If I were to put that in a percent, 4.49. Okay. So I did not put a percentage in each one of these, but you can just follow the math here. And then I did that for each column. So I did that for DHI, Home Depot, Netflix, Starbucks. And I went all the way down, built a column for each, and I grabbed the monthly return. The next thing we have to do is get an average monthly return. So for each one of those, just a simple average formula. And I'm doing that for the last 11 years. So DHI had an average monthly return of 1.32. Home Depot had an average monthly return of 1.14, 2.18, so on and so forth. And then I grab the standard deviation because I want to know how this is where my risk, the modern portfolio theory uses a risk and volatility. So you have to get the average monthly return and what the standard deviation is in order to calculate the rest. So that's just a simple standard deviation calculation for each of the monthly returns for that entire period of time. Technically, if you're wanting to do this and you were a fund manager, portfolio manager, you would want to grab much longer than 10, 11 years. You probably at least want 25 years in your data set. But I grabbed 11 because it does have COVID in there. It also has recent tariffs. So I figured it was a decent start. And this is just for illustration. All right, so now that we have that, the next thing we need to do is I've got my average monthly returns, I've got the standard deviation. The next thing we need to do is to go get the 10-year rate. So this is the current 10-year rate, around 4.4. This will give us a good starting point because now what we need to do is figure out, I can get risk-free 4.4% on the 10-year. I need to figure out what my risk premium is above that. If I'm holding equity, I need to be compensated more than the 10-year rate because I can go out and park money out, 10-year rate and get 4.4. If I'm taking risk on the equity and I know it's going to have its ups and downs, I have firm risk. I have all kinds of risk with taking that. I want more than the 10-year for sure. That's my excess premium, we'll call it. So for each one of these, I took and I created another table. We'll get into this here in a second, but I created another table, excess premium. And that is basically taking your average monthly return, multiply it by 12, and subtract the 10-year rate. That's my excess premium, right? So I'm subtracting this. So I've got 11.41. So if I took 1.32, multiplied it by 12, subtract out 4.4, I've got my excess premium. These also pay a yield. So I went out and grabbed the trailing 12-month yield, and I add that to that, and there's my excess premium. So this makes sense. So for DHI, I've got an average of 12% year over year above the 4.4. So technically, DHI in the last 10 years has had a 16% return year over year. But I got to subtract out my risk-free rate because all I care about is what's risk premium. That excess premium that I'm taking, I'm getting compensated for taking the additional risk. So I did that for each one of these. And this is where the hard part comes in. This is the magic. I need to build a covariance matrix. So I'm going to get a variance and I'm going to compare the two stocks. Every one of these stocks will be compared against each other. So I need to build out the covariance matrix. This is the most time-consuming component. So essentially, I'm taking the covariance of my entire population. So if you look at this formula, it's a covariance here, and then I go grab the next one. How does DHI compare with Home Depot? I go do that one. How does DHI compare against Netflix? And so I'm grabbing the monthly returns and I'm comparing it to Netflix monthly returns because I need to see how the two stocks compare with each other from a monthly return perspective. I'm going to do that for each one of these. So then I get all the way down to AG&C, one of my favorites, and there's DHI, and there's AG&C all the way at the end. All right. So then I'm going to go down. I did that for the first row. And then I'm going to copy it simply by doing this. Because now what I need to do is I need to put it down on this side. So I'm building it this way. So I copy this. This is essentially, it's very time consuming. And there's probably a better way of doing this through other tools and other software. But I'm showing you how to do this manually because I think if you can do it manually, then when you go look at the software, you know how it's built. So I grab that. I'm going to copy it. And I'm going to stick it down over here. And I'm going to transpose that. And that's what it's going to look like, okay? I'm going to Control Z because I've already did that. I'm just showing you for an example. I'm grabbing this, and now I'm comparing Home Depot with DHI, Netflix with DHI, Starbucks with DHI, just like we did across the top. Okay. I'm going to do that for each one of these, and then Home Depot, Netflix compared to Starbucks, Netflix compared to PayPal, Netflix compared to Chipotle, Netflix compared to Robinhood, and it just goes down the list. This is very time-consuming. You're just grabbing each one of these rows, sticking it down here, grab this row, stick it down here. And once you have that, then I put my stocks here, and then I grab a weight. I'm going to fill this in with weights, and they all need to equal 1. Just going to randomly do it. It doesn't matter because we're going to use Excel Solver to solve the weights here in a minute. So I'm just going to put some numbers here that they need to equal 1. Underneath the covariance matrix, there is another function where you're multiplying these weights by the sum of these two products. There's the formula. Okay, there's your weights. We're multiplying, and we're summing it. Okay, that's what it looks like. That's our nice fancy formula, and that is our standard deviations of how these stocks compare against each other. All right, so continuing down the path, I'm going to do that for each one of these. Okay. Now I'm going to sum all of this, and I'm going to get the square root of that line. That's my variance. That's my variance of volatility of how each stock performs against each other. Okay, that's the risk that I'm taking to get this return. So this risk premium is factored by multiplying these guys together, because I got to get the weights. I have the weights. I'm going to use solver to get the weights, and we're going to calculate our minimum standard deviation or our minimum risk, use those weights, figure out what my excess return is over here and over here, and then it's going to calculate what my risk premium is. So what's the highest amount of return for the least amount of risk? It's kind of confusing. It's very mathematical, but I'm kind of going through this quickly. And then the Sharpe ratio. I want a decent Sharpe ratio, because if I'm going to take on risk, I want to get paid a little bit. I want to get paid definitely more than that 4.4% we saw in the 10-year. So the way this works, let's go into Solver. You've got to add this to your add-ins. It's your data tool pack. When you go into your file options and then go find your data tool pack, and then you can add Solver data analysis. Solver is a fantastic tool because it does all the number crunching for you. Let me get rid of some of these that I've put in here already. I'm getting rid of my constraints, but I'll walk through this step by step. First thing I did is I said I want to set my objective, which is my standard deviation column. I want the least amount of volatility, the least amount of risk. Go get me that first. Go figure out what my weights need to be to give me the least amount of risk and give me the return at that point. Least amount of risk, greatest amount of return. We'll get to the efficient frontier because that's called the global minimum variance portfolio, and we'll see where that is on our chart. But for now, we're going to set our objective to min. Give me the lowest number possible, least amount of risk, by changing these variables. So I've got B170 to B181, so I'm changing all of these. So Solver, you go figure out all the weights, and you figure out the calculations to give me the least amount of risk. That's what that's saying. And I have to set this to 1 because I've got, let's say, a $100,000 portfolio. I'm going to need to build my weights such that I use up all 100 grand. And so I just set that to 1. And then I can say, well, I don't want any short in here. So on no negatives, because I don't want to short the stock. If I left this on like this, it could potentially say, well, this particular stock, you need to short it, which is fine if you want to do that. But I like to, a lot of funds, actually a lot of hedge funds can't short stocks. There's some that can, but there's some that have rules like mutual funds. You can't short stocks in mutual funds. So this is what they do. They say no negatives. Now go calculate all the weights. You can go pick all your stocks and figure it out and go through each one of these. These are the stocks that I chose for our example. So now I'm going to hit solve. Go through probably a million calculations, and there are my weights. So didn't care for DHI. It's going to add too much risk. It likes Home Depot. It likes Starbucks. It likes AT&T a lot. So it likes Home Depot, and it doesn't really care for these other ones. They must not have enough return, or there's too much volatility or something. And so it's saying, hey, your best bet to get the lowest amount of risk, to get a volatility of only 4.39%, that's really, really low among these stocks, and get a 6.22% return above the risk-free rate. So technically, you're about a 10% return. And this is our Sharpe ratio. So I got the least amount of volatility And there's my return I'm going to get for that. Now let's go back to AT&T real quick, and I'll tell you why it likes AT&T. Intuitively, you probably already know AT&T is a stock that does not move. It pays a decent dividend, like 6 or 7% right now, but it doesn't move. Our average monthly return is 0.08, and look at the volatility on that, 5%. So our standard deviation is only 5%, which means the average monthly returns from one month to the next, you can expect a 5.74% plus or minus. So that's pretty low. Whereas like, where's NVIDIA? NVIDIA's got a 12%. You got a 4% average monthly return, but look at the volatility on that. So that means 68% of your return could be between 16%, because I'm going to add these two. This is my average. And if you know bell curve, one standard deviation either side of the mean is 68%. So that's 16% positive or 16% negative. So that's the risk that you take with NVIDIA. While it has shot through the roof, but it does have a lot of volatility with it. And then there's some other stocks. Look at Robinhood, 20% volatility. So that's the risk of that. So you can have a plus or minus on the bell curve. All right. So now I've calculated these two things. I'm going to go back into Solver. I'm going to go back into Solver, and we're going to build out the efficient frontier. Because all I've done at this point is build this dot right here. There's my 6.22 and my 4.39% variance right there. That is your what they call the global minimum variance. It is the spot at which you get the best return for the least amount of risk. Now we're going to build out the rest of this. So I'm going to go in here and go back to Solver and say, let's add a constraint. Now I say, just for illustration purposes, I want to build out this efficient frontier because I'm going to show you that there's a point at which I can get less return, but I'm taking on more risk, or I can get more return and I'm still taking on the same amount of risk. This is your return line. This is your risk line. And so this is the most efficient spot right here because, again, I can say, well, give me lower, let me get a lower return and see if it gives me lower risk. Well, actually, if I get a lower return, I'm actually taking on higher risk. All right, so let's do that. So I'm going to add this, and I'm going to say, set this risk premium. I want to take on, I don't know any better. Let's just pretend. And I'm going to say, give me lower. I'm okay with a lower return because I think it's going to give me lower risk. You think, right? Based on the volatility and all this mathematical framework, you'll see it doesn't work out that way. So I'm going to set this to 0.5. So I'm going to say, you know what? I'll take lower risk. Watch what happens. Now I'm going to solve it. Okay. You still give me the minimum amount of risk. My risk premium is now 5%. So I lowered my return, but my risk actually went up 4.42. So that's this spot right here. That's pretty cool. Or let's say, all right, fine. I want a better return. Give me 10% return above the 4.4. So give me a 15% return, 14% return. Let's just play with that. So I'll go here and we're talking total return minus the 10-year rate. So if I'm talking 10%, we got a minus 4.4. So that's it'd be 14.4% total return minus the 4.4 gives us the 10. So let's go with here, 0.1. I want a 10% or 14.4% return. Solve this. Now look. So I'm going to get my 10% return above the 10-year rate, but my standard deviation, my risk goes up to 4.52. And that is this spot over here. Look at this. I'm taking on a whole lot more risk for a 10% return. I mean, I'm taking, while technically speaking, it looks like a whole lot more risk. It's only 4.4 to 4. You're taking on a little bit more volatility, say 4.42, something like that, all the way up to 4.49. So the volatility measures still aren't that big of a difference to get the little bit more return. But this is, again, for illustration, if you had 100 stocks that you were regressing and building out the variance between each other, this is how you would do it. All right, so I'm going to select, now watch this. The problem is if I want that higher return, it's going to give me different weights among, it gives me Starbucks. It really likes Starbucks. It gives me Home Depot at 21%. Well, we all know by intuition, we shouldn't put all our eggs in one basket. And that's a third of our funds going into AT&T. It likes AT&T mathematically. This is one of the downfalls of modern portfolio theory. You've got to be able to set here. I'll show you how to do this. Let's say I don't want to put more than 10% in any one of these. So now go figure out what that looks like. So I'm going to add, set my weights, and I'm going to say all of them need to be less than 10%. I don't want any portion of my portfolio to have more than 10% allocation. Okay, solve. There you go. Now it's going to go through, and it picked 10% Home Depot, 10% Starbucks. So it's finding, but look at my standard deviation now. Oh, let me delete my risk premium. See if that changes anything, because I'm saying, hey, give me at least 10%. That was this one. Delete. Now solve. Okay. That's how it's allocating it now. 10% to AT&T, 10% to JP Morgan. But for the least amount of risk, this is the weights it's just recommending, and my risk premium is 7.72. So there's my return. So roughly 11% return, but I'm taking on more volatility. All right, let's do one more. Now I say, well, I like all these stocks, and it's not allocating enough to some of these. So let's go add another constraint. Say grab all of these, and let's at least put 2%. I want at least 2% of my portfolio being allocated to each of these stocks. Click OK. All right, solve. And there you go. Now I've got a 9% return. My volatility went up even more because now I'm allocated to stocks that it thought shouldn't be allocated to, based mathematically. And now it's got a greater volatility. So I'm going to have greater variance in my portfolio now by these constraints. I said no more than 10% and at least 2%. Go calculate that. Now, this is only based on 10 years worth of data. So this is another downfall, is it is not forward looking. Can't stress that enough. You have to know what's coming up in the economy. You have to know what that company's doing in the future. Listen to their forward guidance, listen to their earning calls, and look ahead and see what it's doing. The pitfall, one of the biggest pitfalls of modern portfolio theory, is it uses historical and historical only. And in this case, I used only 10, 11 years. You want to use at least 25 or more, but it just takes more time. I'm showing you, if you want to go through and build your own fund and know how to do this mathematically, or you're doing this for exercise for a school project, this is a great example of how to build a covariance matrix and how to build the efficient frontier. So there we have it. In short, one more thing I want to show you is how to build your distribution histogram. So I'm gonna delete this because I was looking at AT&T. I'm like, well, let me see how it's distributed here, how the monthly returns are distributed. So let me show you that real quick. So let me get rid of this. Whoops. Delete. All right. So I'm gonna use this. Let me do this a little bit more because I'm gonna use NVIDIA. I'm gonna do point. Let's do 0.3. So 30% down. Just want to see what this looks like. And this one I'll do, let's do by 3, so 2.7. No, let's do by 5. All right, so this is saying a 30%. We're trying to find out what our distribution is, so that would be the tails, hopefully. These are the long tails. Okay, and then there's the mean. So let's build this out. So you go to data analysis now, build the histogram, and you say, what's the input range? So let's go look at, let's just, for grins, let's look at NVIDIA. All right, so I'm gonna go grab all those monthly returns. Where's my bin range? Here. And where do I want to put it? My output range is already selected. So let's do that. Okay, so you can see the returns. It had 1 month looks like, where it was less than 30%. It must have been was probably an interesting month. We'll have to go. Let me just go look at that because that's got me curious. Where is that? Well, let's do this. Just to make it fast, I'm going to put in some conditional formatting, so it just helps highlight it for me. So there's this one, 28% return. Oh, back in the very beginning. And then, yeah, there's 38%. So 27, yeah, $9 down that month. That was back in 2022. Yep. So, and then, yeah. Okay. Anyways, just kind of wanted to see what that looked like because that was interesting. So now you had 2 months greater than 30%. So fantastic. And there's the distribution. You can see it's biased to the upside as you expect because NVIDIA has just knocked it out of the park. And let's do this as, let's just say 0.35. We know it's more than that, or more than 0.30. But just to graph it, I'm going to go to my XYZ. And there's the distribution of my monthly returns for the last 10 years. So that is, you can definitely tell it's biased to the upside. So one standard deviation is 12.63%. So right here, that is 68% of your returns are between here and here. 16%, 16, and 16. There's your 68%. Okay, it's not a perfect bell curve because it's reality. But that's how you build out the distribution curve and the bell curve for each one of these. You just go into Solver, go into your histogram, build out your bins of how you want to set up each one of these bins, and then it'll calculate. And then you can go just do a XYZ chart on that. So that was a little bit lengthy video, so hopefully you enjoyed it. If you did, please subscribe. Please send me any questions. Drop a comment down in the link, and let me know if you'd like more of these videos. Thanks, and have a good one.